BlackRock has been buying homes around the country at record-breaking speeds, and hedge funds have been joining the party. Housing is becoming extremely expensive, which is making it very difficult for all people, millennials, old people, young people. What's up, everybody? I'm Jaspreet Singh, and the housing market continues to be on fire, even though interest rates are now rising. So what I want to do today is go over what every home buyer and seller needs to know, especially when it comes to today's market. So let's jump right into it. If you are in the market for a home right now, not only do you have to compete against a whole bunch of other people that want to buy a home, but you're also competing against investors who have cash, who are buying homes without a mortgage, and you're also competing against corporations and hedge funds that are buying up properties for their investment portfolio. There's a lot of concerns about what's going on right now. The first concern being, why am I recording this video here sitting down? And that's because, well, the rest of my office is having some electrical issues, so we're getting that taken care of. The second concern is what's going to happen to the housing market. The first major concern of the housing market goes back to March 27th, 2020, when President Donald Trump signed the CARES Act, which provided some relief to homeowners. The economy was shut down, so nobody's working and nobody had a paycheck, which meant nobody had money to pay their mortgages. So the government signed the CARES Act, which allowed people to put their mortgages on forbearance, meaning they put their mortgages on hold. And that's when lots of experts predicted that this was going to create a wave of foreclosures. We were going to see a tidal wave of foreclosures as soon as the forbearance program ends, because when it ends, then you're going to see millions of Americans exit the forbearance program, and then they're going to be hit with their mortgage payments and their penalties, and this is going to create a massive wave of foreclosures. And well, that wave never happened. For one, we saw home prices skyrocket. So even if you exited the mortgage forbearance program and you didn't have money to pay your mortgage, well, it wasn't that big of a deal, because you could just sell your home and walk away with a big profit, or you could refinance, or you had a number of different options because home prices had gone up so much. So there was no reason for you to go into foreclosure, because if you couldn't make your payments, you could just sell your home and walk away with a bunch of cash. And second, if you were a homeowner and you put your home into forbearance, you didn't have any direct cost of putting your home in forbearance. Like, you just had to apply and say, I want to put my home in forbearance. You didn't even have to show any hardship, and then you didn't have to pay your mortgage payments. And then when the forbearance program ended, well, all you had to do was start making your mortgage payments again. You didn't have to make any sort of lump sum payment. You didn't have to make up for your back payments. You didn't have to pay any extra interest. You just started paying your mortgage payments again as if nothing happened. I said that you as a homeowner didn't have to pay a direct cost, because there is a cost to people not paying their mortgages. Remember, these mortgages that were put on hold through the CARES Act were government-backed mortgages. So these are things like the FHA mortgages. And if they're government-backed, that means these agencies are not receiving any money. There's still a cost to running business. And so if this is a government-backed agency, FHA is a government-backed agency, and they're not making any money, who will support them? Well, none other than the United States government. And so if you have millions of homeowners that are not paying their mortgages, which should be going to a government-backed entity, and this government-backed entity is not making any money, well, then they will go to the government. And if the government doesn't have any money because the government is drowning in debt and they don't have money to pay their bills as it is, who are they going to go to? Well, none other than taxpayers and the tax dollars. It goes back to the regular people. So there was a cost to the mortgage forbearance program, but it was just passed on to taxpayers, and most people never even knew that happened, because no one really knows where the tax dollars are going. But now there's a new concern in the housing market, and this one has the potential to cause a lot more issues than the forbearance program, because the forbearance program really didn't come with any direct cost to the homeowner. The reason so many people are worried about the housing market is because everybody still has that looming fear of what happened in 2008 back in the back of their minds. Because in 2008, you had a big chunk of America that was underwater on their homes, and if you're underwater in your homes, that means you owe more debt than what the home is worth. And if you owe more money than what the home is worth, you can't sell it, because then you're going to have to come to the closing table with a whole bunch of cash. You can't refinance, because no bank is going to give you money on a home that you already owe more money than the home is worth on. And then you can't leave, because now if you're stuck, you can't make the monthly payments and you can't sell it and you can't refinance. Now you're stuck, and that's when the bank has no other option but to take the home away from you. So the number one thing that you want to pay attention to when it comes to the housing market, especially if you're worried about a housing market downturn, is equity. How much equity do people have in their homes? Because if people have equity in their homes, then you're not going to see a major crisis in the housing market, because if people have some sort of hardship, they can just sell their home for a profit. But if people don't have equity in their homes and they're underwater, well, then they won't have any options, and that's when you start to see a big uptick in foreclosures. And when you see more foreclosures, then you will see banks purchase properties and they'll just want to liquidate them, meaning they'll sell them at a discount, and this is what pushes home prices down. The concern that economists and Wall Street have now has to do directly with the Federal Reserve Bank, because the Federal Reserve Bank is being forced to raise interest rates in 2022 to combat inflation. But the problem with raising interest rates is it is going to make it more expensive for somebody to go out and buy a home. Home price affordability is already at the lowest levels that we've ever seen. And now if you want to go out and buy a home, it is going to get more expensive in 2022, even if home prices don't go up, because it's going to cost you a lot more money to service your debt payments. It's going to cost you a lot more to make your monthly mortgage payments, because interest payments are expected to go up quite a bit in 2022. That's why you see so many people from the Motley Fool to Forbes to NASDAQ trying to predict if we're going to see a housing market crash in 2022 due to the rising interest rates, because as it becomes more expensive for people to buy a home, less and less people will be able to buy a home. And if you have less people trying to buy homes, well, then that could create a dilemma in the housing market, because if somebody's trying to sell their home and nobody's buying it, then they're going to have to cut the price on their home to attract somebody to come and buy it. This is how supply and demand works. If you have more demand than supply, well, then these people are going to fight against each other to buy the limited supply of homes, which pushes home prices up. But if you have more supply than demand, and now you have a whole bunch of sellers that are trying to sell their home, but nobody wants to buy it, well, now the sellers have to compete against each other, and the way that they do that is by cutting prices. This is what we saw happen between 2008 and 2012, where sellers were trying to sell their home, but nobody wanted to buy it. That was a buyer's market. If you bought a home between 2008 and 2012, you probably got a massive bargain. But if you want to buy a home between 2021 and 2022, now you're competing against a whole bunch of people and you're not getting a bargain on a home, but you can still get a home with low interest rates. The thing that you really want to pay attention to is how much interest rates will rise. And we don't really have a definite answer on that, but that's going to determine how much more expensive it will be for you to go out and buy a home. Because if we see the Federal Reserve Bank raise interest rates significantly, meaning they raise it multiple times, well, that's going to really make housing less affordable. But if we only see a couple or a few interest rate hikes, well then yeah, that will make housing less affordable, but it's less drastic. And this is one of those things where unfortunately we're not going to know until we actually see what the Fed does. Like, I can say what we think the Fed should do, but what the Fed should do is different than what the Fed will actually do. Some polls say that the Federal Reserve Bank is going to raise interest rates 3 times in 2022. Some officials say that the Fed is going to raise interest rates 4 times, and then you have some bankers that say that the Fed is going to raise interest rates more than 4 times in 2022, and then you have some people saying that it's possible for the Fed to raise interest rates 7 times in 2022. See, the Fed kind of works like a magic act. They'll tell you what you need to be aware of, and they'll tell you some things that you want to pay attention to, but sometimes it's just a sleight of hand, and you're not actually going to know what the Fed is doing until they actually do it. That's why we don't know what the Fed is actually going to do until they announce it, and we can guess and we can predict, and the Fed might give us hints, but we really have no idea until the Fed has a meeting and then they tell us what we need to know, and that might be a surprise. It might be something we predict, but there's no way for us to know. The dilemma that the Fed is facing right now is that they need to raise interest rates in order to fight inflation, but the problem is if they raise interest rates, that's going to slow down the economy, because then it's going to become more expensive for you to go out and buy a home. And when we saw the Fed try to raise interest rates in 2021, we saw that home buying slowed down significantly because people didn't want to pay the higher interest rates. And so the Fed needs to raise interest rates. Inflation is getting out of control. It's becoming very hard for people to afford life. And so the Fed needs to raise interest rates because that's how they fight inflation. But if they start fighting inflation, that would hurt the economy. And if that hurts the economy, that means realtors won't be getting paid as much. Bankers won't be getting paid as much. Title companies won't be getting paid as much. Contractors won't be getting paid as much. Builders won't be getting paid as much. So that will slow down the economy, and that's the worry that the Federal Reserve Bank has. The reason that the Fed says that they're willing to raise interest rates is because the economy has been growing pretty significantly. We saw the economy boom in 2021 because people had a lot of cash in their pockets. People had cash because they weren't spending in 2020. They really just started to go out again in the middle part of 2021. So people had that pent-up demand, and they had the cash saved up because they didn't have as many expenses. And so now when the Fed is trying to debate what they should be doing to help support the economy, they want to fight inflation, but they also don't want to hurt the economy. See, the underlying problem is that inflation is getting really bad. The Fed was hoping that inflation would have completely gone away by the end of 2021. That's what they originally predicted. Now they're saying that it'll be gone by the end of 2022, but the way things are looking, it doesn't look like it's going to be slowing down at all in the end of 2022, which means it is going to become very very expensive for average people to afford anything just because the prices of things are going up so much. And the reason why the prices of things are going up is not just because greedy business owners are raising the prices. It's because the value of the dollar that you're using to buy these items is dropping every time you see more inflation. And when you have lower interest rates, that creates more inflation because lower interest rates contribute to more lending. More lending means more dollar enter our economic circulation. And when we have more dollars in our economic circulation, that makes the value of each individual dollar that you have and the value of each individual dollar that you earn go down. That's why so many people who got a raise in 2021 are poorer now than they were before, just because the raise that you're getting at your job isn't enough to keep up with the higher inflation. I'm a money nerd, so I love studying historical financial trends, and the last time that we saw inflation this bad was back in the early 1980s. This was after a period of very high inflation in the 1970s, and in order to combat the inflation that we saw in the 70s and the 80s, the Fed had to significantly raise interest rates. If you wanted to go out and get a mortgage in 1982, it wasn't going to cost you 3 or 4 or 5% a year. A 30-year fixed rate mortgage was going to cost you somewhere between 15, 16, 17, and 18% a year in interest. The reason why the interest rates had to go so high was because that was the only way that the Fed could fight the growing inflation. We're already seeing the same inflation today that we saw back in 1982, and if the inflation that we're seeing today does not significantly slow down, well, then that might force the Federal Reserve Bank to significantly raise interest rates, which would make buying a home significantly more expensive. Like if you went out today and you borrowed $500,000 at 3.5% a year to go out and buy a home, it would cost you just over $2,200 a month to borrow that $500,000 at 3.5% a year. But if mortgage rates went up to just say 6%, which historically isn't even that high, it's a lot higher than what it is now, but historically it's not that much. If you went out and borrowed $500,000 at 6% a year, now your mortgage payments are going to jump up to $3,000 a month. That means you're going to be paying almost $800 more a month on the exact same home just because mortgage payments are a lot higher. That's an extra $10,000 a year, and over the course of your 30-year mortgage, that's an extra $300,000 that you're going to have to pay on the exact same home, on the exact same home price, just because you're buying the home at a higher mortgage rate. This is one of the reasons why so many people are trying to capitalize on the lower mortgage rates and the lower refinance rates before the Fed starts to hike interest rates, because that's going to make borrowing money more expensive. I know I've said this before, but I want to say it again. If you are shopping around to get a mortgage or a refinance, there's a couple things you want to be aware of. First, don't borrow more than you can afford. At the end of the day, you're going to have to pay the money back. So even if interest rates are cheap, you don't want to be over leveraged, because you don't want to start living paycheck to paycheck just because you could go out and borrow money at 3.5% a year. And second, if you are going to get a mortgage or a refinance, make sure you shop around, because some lenders are going to charge you so much more in fees and interest than other lenders on the exact same loan. If you want to gauge how fast the Fed is going to raise interest rates, the thing that you want to pay attention to is how strong the economy is, because the Fed has said time and time again that the thing that they're paying attention to determine how fast and how much they're going to raise interest rates is how strong the economy is. They say things like, how full is unemployment and how well is our economy operating, because the Fed knows that once they start raising interest rates, it is going to slow down the economy. So the last thing that they want to do is slow down the economy when the economy is already slowing. And so we're entering a weird phase right now, because we're coming out of 2021, we're entering 2022, and in 2022, we're already starting to see the economy slow down a bit, because in 2021, people had a lot of money and they were spending this money. This spurred a bunch of business growth because people were spending like crazy. Prices of things kept going up, but people kept spending. They didn't really care. And so businesses kept making money, even though they had to raise the price of their products because of inflation. And now in 2022, people's bank accounts are getting depleted. And so they don't have the ability or the means to spend it the way that they did in 2021. So people are having to downsize. And now that people are downsizing, businesses are starting to feel the pinch. They're already starting to realize that they're not making as much money now as they did before. This was the worst January that we've seen in history. And so we're starting to see the economy already start to slow down. And at the same time, the Fed is having to really start to worry about inflation, because if they don't raise interest rates, then inflation might get out of hand, and that could create a dollar crisis. And so the Fed is trying to dance on fire here, trying to manage both. And what they might end up doing if they don't start managing the problems is they might create a doubled problem where you have an economic recession and you have an inflation crisis at the exact same time. And that would really create a problem, because if you see an economic slowdown, then the Fed would not have the ability to cut interest rates and stimulate the economy, which is what they've done in the past. Remember, in the 2008 crash, the Fed slashed interest rates and created stimulus. They created more inflation, and that was their way of stimulating the economy. We saw the same thing after the 2001 dot-com crash. We saw a cut in interest rates, and we saw stimulus by the government and the Federal Reserve Bank to help stimulate the economy. Well, now we're on the verge of entering a recession induced by inflation, and you cannot fight an inflationary induced recession by creating more inflation. Well, let me rephrase that a little bit. You shouldn't fight an inflationary induced recession by creating more inflation. That's not saying that you can't, because I guess technically the Fed could. Because if we started to see the economy slow down even more, and the Fed started to worry about unemployment, and the Fed started to worry about spending, and the Fed started to worry about business growth, and then they said, you know what, we are going to pause these interest rate hikes. This is possible. If they decide to do that, that would make the dollar crisis worse. And that would make housing prices go up even more, because then they would cut interest rates, maybe create more stimulus. And if that happens, well, then you would see a lot more inflation. You might help spur the economy in the short term, but you're going to see a bigger divide between the rich and the poor. And you would see housing prices really start to go up then, because the value of the dollar would really be dropping. Back in 2020, before anybody was worried about inflation, I started talking about how inflation would be a major problem in the future. Then in 2021, that's when we started to hear more concerns about inflation, and that's when the Fed said that inflation is transitory, there's nothing for you to worry about, and that's when I kept saying that this inflation is going to get worse. Then towards the end of 2021, that's when the Fed finally said that inflation is not transitory, and now here we are in the early part of 2022, when the Fed is still saying that this inflation is going to go away by the end of 2022. Now, I don't think that's going to happen. I don't see how we are going to get out of this inflation mess unless we start to see major changes by the Fed. I don't think that we're going to see the major changes by the Fed that we need to fight inflation, because that means that the Fed would have to significantly raise interest rates, and our economy doesn't look like it's strong enough to support these rising interest rates, because the Fed doesn't want to see a slowdown in the economy. And if the Fed does not want to see a slowdown in the economy, and they're not willing to raise interest rates, and if they reverse course and they start to cut interest rates, that is going to make the inflation problem worse. This is why you need to be aware of what's going on. Now, there is a chance that the Fed says, you know what, this inflation is getting out of hand. We really need to take care of it before it becomes a bigger problem. If that happens and we see 7 interest rate hikes in 2022, well, yeah, that would be good for the dollar, but it's not going to be so good for the housing market, because then people are going to be priced out of the housing market, and you would probably see housing prices go down, and you'll also see stock prices go down. But if the Fed decides not to do that and they say, you know what, screw it, inflation isn't that bad, it'll get better in 2023, we're just going to continue helping to support the economy, that's going to make a much bigger inflation problem, and that ultimately makes all the bubbles that there are even bigger. Because inflation is just pumping a whole bunch of hot air into the economic system, because you're printing a whole bunch of cheap money, you're printing a whole bunch of dollars, and once people start to realize that these dollars are just pieces of paper, well, then that's when people start to get concerned about the state of their wealth and their economic well-being, and that's when people might start ditching the dollar and buying other assets to protect their money, to protect their wealth, and to protect their economic well-being. We're going to jump back into the video in just a second, but before we do, if you're an investor and you're looking to get better returns on your money, I can help you. I've been investing my money for over a decade now, and what I've learned is that the number one way to make more money on your investments is by actually investing your money and then by learning from your mistakes. But this can be very time consuming and very expensive. That's why the second best thing that you can do is by learning from other successful investors. Learn from their successes and learn from their mistakes. That's why I created Market Insiders, which is an investing education app where you'll get access to top level successful investors in the real estate, stock market, and cryptocurrency space. Every week, you'll get access to group coaching calls where you'll learn how to be a better stock market, real estate, and cryptocurrency investor. So if this sounds like something that would be beneficial to you and your investment portfolio, I'll put the link to where you can try out Market Insiders for free with a 10-day free trial in the description below. The housing market has been through a very weird decade. About 10 years ago, in the early 2010s, that's when the housing market was really just still recovering from the 2008 crash. When we came into the mid 2010s, so around 2015, that's when the housing market really started to recover and it was really starting to boom. Then coming closer to 2020, coming into 2019, that's when the housing market and the whole economy started to slow down, and that's when the Federal Reserve Bank came out in 2019 and they started cutting interest rates, making it cheaper for you to go out and borrow money. So in 2019, before we were in a recession, we saw interest rates get cut not once, not twice, but 3 times in 2019. This made it cheaper for you to go out and get a mortgage, and this encouraged more people to go out and buy a home. Then came the 2020 pandemic, and as soon as that hit, the entire real estate market froze. People stopped selling homes and people stopped buying homes. Nobody wanted to sell their homes because no one wanted people who were potentially sick walking through the properties, and nobody wanted to go out and buy a home because our whole economic future was so uncertain. But then as people started to understand what was going on with this virus and the pandemic, people started coming out of their homes, and they saw that now in 2020, people saw that interest rates were cut to new historic lows, so now you could go out and get a mortgage at record low rates. So people started going out and taking advantage of these mortgages to go out and buy a brand new home. Then towards the end of 2020, all the people that were thinking about buying a home earlier that year came back out and they started buying homes because now they realized, hey, mortgage rates keep falling. I can go out and buy a $500,000 home and only pay 3% a year on my mortgage, and this is a 3% a year fixed rate mortgage. So now people were taking advantage of these low interest rates, and now you had a huge demand of people wanting to buy homes, and now home prices started to go up. Then in 2021, people really started to realize that this pandemic changed the way that we do work, because people want the ability to now work from home. And if you're going to be working from home, you might as well have a nicer home. You might as well have a home with an office in it, and you might as well have a home with another bedroom because you're going to be spending so much more time there. So now people started looking for homes where they can live and work in, and people wanted to move out of the cities. So then in 2021, you saw a new demand for people wanting to buy homes because interest rates were still super cheap, and now people wanted a home where they can work and live. At the same time, mortgage rates stayed historically low, and you had a very low inventory of homes available for sale because it was taking longer for companies to build new homes, and still a lot of people were not selling homes, and you still had the mortgage forbearance program and the eviction moratorium, which was slowing down how many people were selling homes, and it was also slowing down foreclosures. So you had a limited inventory of homes available for sale, and you had a lot of people that wanted to buy homes, and you had very low interest rates, which made it very attractive for people to go out and buy a home. The advantage of having a 30-year fixed rate mortgage is no matter what happens in the economy, no matter what happens to interest rates, no matter what happens to housing prices, your mortgage payment is not going to change. So as long as you can afford your housing payment, it doesn't matter what's going on in the world because you have a fixed rate mortgage. This is different than what happened in 2008, because before the 2008 crash, everybody had a variable interest rate mortgage, which meant that as interest rates went up, so did your mortgage payments. And so now you had everybody going out to buy a home back in 2008 with a variable interest mortgage, and during the first 2 years, you had a teaser rate, which meant you could get a mortgage, and in the first 2 years, you might only be paying $500 a month. And then when your new interest rate kicks in, well, now you went from paying $500 a month to $1,800 a month almost overnight. All these factors came together to create a very different housing market today than what we saw 10 years ago. 10 years ago, we were in an extreme buyer's market where you could go in and buy a home for literally pennies on the dollar. Now we are in the exact opposite. We are in an extreme seller's market where right now buyers are willing to pay way more than asking price to buy a home because you have so many people that want to buy a home and not that much inventory of homes available for sale. But now it looks like this housing market might be slowing down. CNBC put out an article titled that the housing boom is over as new home sales fall to a pandemic era low. We went from seeing new home sales break record highs to now new home sales going back to what we saw during the beginning of the pandemic. So let's talk about what's going on. Here's what CNBC is saying. Month over month, we've been seeing the housing market boom, boom, and boom even more. What we've been seeing is that new home sales have been growing by about 20% month over month on an annualized basis. But now in July of 2021, we saw it grow not by 20%, but all the way down to just 6%. Now, month over month, that's still a very high growth, but compared to the growth that we've been seeing, it's a lot smaller. This is why a lot of people are starting to theorize that a housing market might be finally cooling down. Business Insider says that the housing market is starting to get better after a historic affordability crisis because home prices have gone up so much, and Market Watch says that the housing market, quote, is no longer heating up according to a new report. The reason why it looks like the housing market is cooling down a little bit is because of two things. First is because of home prices, and the second is more inventory of homes available for sale. Home prices have been going up at record-breaking rates. And you don't gotta be a random guy on YouTube to know that if home prices are going up this fast, but wages are only going up this fast, that eventually you're gonna hit a point where people can no longer afford new homes because their wages aren't growing as fast as home prices are. This is the issue that we're seeing right now with home prices. So many people feel like they're being priced out of the market. This is what the Business Insider article talked about. People feel like they cannot afford homes anymore because home prices keep going up so fast, and now they go look at the price of homes and they get sticker shock. How much money you want for that home? $400,000. Unless you can find a deal, it's becoming harder for people to find a home that they can afford because now they're having to look even harder to find a home that fits their budget. The second thing is the higher inventory of homes available for sale. So this is good news for home buyers because now you're starting to see more sellers enter the market. More and more people are starting to list their homes available for sale, and more homes are finishing construction, which means now if you go shopping for a home, you got more options, which is something you want to see if you're a home buyer. The Business Insider article really dove into this, but these higher home prices affect the demand side of the housing market because when you have such high home prices, you have less people that want to buy a home, and the higher inventory affects the supply side of the housing market because now you have higher supply. Higher supply, less demand, which can help slow down the housing market. Now, this is what we're seeing happen. We've been seeing the inventory of homes available for sale grow month over month, while people have been turning away from the housing market because they just can't afford to go out and buy a home right now. Both of these coming together have slowed down the housing market from the record-breaking months that we've been seeing. Now, I'm not saying this to tell you the housing prices are about to come down tomorrow. What this means is the housing prices are growing not as fast as they were before. A housing market slow down or cool down is great news for people who want to be home buyers because that means you have a better opportunity to find a home that you love and that you can afford, but it's not so good news for the government and for banks. The United States is not technically on paper in a recession anymore, but our economy is still hurting. And one of the biggest drivers of our economic success right now is the real estate market. When the real estate industry is booming, it's great news for the government because it looks like the economy is booming. When the real estate market is hot, that means real estate agents are making money. That means banks and mortgage lenders are making money. It means that title companies are making money. It means that the construction industry is making money. And that means companies like Home Depot and Lowe's are making money because people are going to be going to these stores to buy things to renovate their homes. But if the real estate market's slowing down, that means all of these industries are slowing down, which is not good news for the economy, which is not good news for the government. That's why the government has been working with the Federal Reserve Bank, and the Federal Reserve Bank has been working with big banks to keep mortgage rates at historic lows. In the early part of 2021, we started to see mortgage rates rise pretty quickly, but then when they saw that people stopped going out and getting mortgages, they turned that around very fast, and mortgage rates fell back down to below 3% again. And now, still today at the time we're recording this video, mortgage rates are still near historic lows, which is great news if you own a home because now you can go out and refinance on your mortgage, assuming you do it smartly, and now you can pay less money on your mortgage because you can borrow money cheaper. And if you're going out to buy a home, assuming you find a home that you can afford, you can borrow money at very cheap rates, which allow you to go out and buy a home and lock in your mortgage rates for 30 years. The reason why these fixed rate mortgage rates are so interesting right now is because if you go out and you get a mortgage, and let's say your mortgage payments are $1,500 a month, and this is at a 3.5% interest payment. Well, in 2021, the annual inflation is right around 5.4% a year inflation, which means the value of money is going to be dropping. And so what inflation tells us is how much buying power our dollars are losing. So let's just assume that over the next 30 years, inflation is just half of this. And so that assumes that we're gonna stop our money printing and we're gonna slow down our government deficit. If that happens, that means in 30 years, your $1,500 that you're paying a month isn't gonna feel like the $1,500 you're paying today, because $1,500 a month is more today than it will be in 30 years. In 30 years, your $1,500 a month is really only gonna have a real value of half of that amount because we're seeing such high inflation rates. That being said, if you are in the market for getting a mortgage or refinancing a mortgage, I want you to borrow money smartly because I don't want you to be over leveraged and be left in a position where now you're underwater on your home. Plus, when you're looking for a lender, make sure you shop around because some lenders are going to charge you a whole lot more money and a whole lot more fees than other lenders. So shop around, that way you can keep the most money in your pocket. When people hear the words the housing market is cooling, here's what they think. So up until now, we've kind of seen the housing market go like this. Here's where we are now. And now when people hear that the housing market is cooling, they assume that this means that the housing market is going to go like that. But that's not what the housing market cooling means. What the housing market cooling means is that instead of the housing market going like this, we might see the housing market go like this, or like this, or like this. See, that still means that the housing market will continue to grow at its current rates because we still have way more demand than we do supply. And as long as we have more demand than we do supply, the housing market will continue to go up. Now, what we're seeing happen is that we're seeing more supply, less demand, which means that the housing market isn't going up as fast as it was. The reason why we're seeing less demand is because people can't afford the homes anymore. And the reason why we're seeing more supply is because more and more people are starting to sell their homes. Well, as long as we see more demand than supply, we're going to continue seeing the housing market to go up. At what rate? Well, this is going to depend on how many buyers and how many sellers there are. But if we start to see more supply than there is demand, that's when we could start to see the housing market start to slow down even more, or maybe even potentially come down to create a correction in housing prices. Again, we don't have the same factors today that we saw back in 2008. Back in 2008, we had the variable interest rate mortgages with the teaser intro rates, which meant people could go out and buy homes and they didn't really know what the real cost of their home was because they were on a very low teaser rate, and a couple years after buying the home, that's when the mortgage payment spiked. Back in 2008, we also had a lot of ninja loans. Ninja loans were an acronym which stood for no income, no job, no asset loans. So you could walk into the bank and say, hey bank, I want to buy this $400,000 home, except I don't have a job and I don't have any investments. I just want to buy the home. And the bank would say, sure, no worries. Here's your money to go out and buy your home. If you want to go out and buy a home today, it's not easy. Banks are going to qualify you. They're going to want to see how much money you're making. They're going to want to see your pay stub. They're going to want to see what assets you have. So banks are qualifying buyers, and people are going out and mainly buying homes with 30-year fixed rate mortgages. Now, this doesn't mean that we're not going to see a housing price correction. I mean, if home prices keep growing way faster than wages, then sure, eventually you're probably going to see a home price correction, because if interest rates go up, which they will eventually go up according to the Federal Reserve Bank, I don't know when that's going to be, but they keep saying that it will go up probably something around 2022 or 2023. But when interest rates go up, now if it's more expensive for you to go out and get a mortgage and housing prices are way up here, people are not going to be able to buy homes. So now you're going to have less demand because people are not going to want to buy a home. And if the supply of homes keep going up, well, now you're going to see a shift in the supply and demand curve, because then you'll see more supply and less demand. When that happens, you can see housing prices start to correct until we see market equilibrium happen again. How big is that correction going to be? Well, there's no way for me to predict that. I have no idea how big the next housing price correction will be, and I also don't know when it's going to be. It's impossible for me to try to time the market. All I want you to do is understand what's going on. The last thing that I want you to pay attention to when it comes to the housing market are government regulations, because we are not in a normal economy. A normal economy is when businesses are running without free government money. It's when people are going out and spending based off of money they're earning from the job, not money from the government. And so right now, we are still in a very strange economy where you still have a lot of people that are relying on the government to pay them, whether it's people and businesses. People are still relying on the government, but this money is starting to wane away. As we see the mortgage forbearance program come to an end, and as we start to see the unemployment money go away from the government, then we're going to really start to see how strong our economy is. A lot of people have been holding their breaths, wondering what's going to happen as soon as the mortgage forbearance program ends. Are we going to see a brand new wave of foreclosures, or are people going to suddenly be able to pay their mortgages again? This is something that we're going to see towards the end of 2021 and into 2022. These are factors that are really hard to calculate because these are not normal things that we see in a normal housing market. But if we start to see a huge wave in foreclosures, that can shift the entire housing market, because that would bring in a whole new wave of inventory of homes available for sale, which could shift the supply and demand curve. Up until now, the supply and demand curve had been kind of shifted on the opposite way, because everybody wanted to buy a home, but people were in forbearance, so they had no incentive to sell their home. And if you were in mortgage forbearance, you also couldn't be foreclosed on. So you had a whole inventory of homes that were locked up, and now this could be shifting. And you also have people that have been paying their mortgages through the help of the unemployment money that they've been getting from the government. And so if that money goes away, or when that money goes away, if those people don't have a means to pay their mortgages anymore, well, that could also bring in new potential foreclosures. This is why you have so many real estate experts confused about what's going on, because you can't just look at the housing market by itself. You have to look at the entire economy, and you have to look at all the government programs out there, because these are things you don't normally see in a normal housing market. But these are the things that we're seeing right now. And as we start to lose this free government money and this government support system, that's when we're really going to understand how strong our economy is. And based off of that, we will really know how strong our housing market is. And these are things we're really going to discover over the next 6 to 12 months. Do you want to know who the biggest first-time home buyer is right now? No, it's not millennials. It's investors on Wall Street. BlackRock has been buying homes around the country at record-breaking speeds, and hedge funds have been joining the party because now they're buying homes, and we're seeing institutional investors buy homes at record speeds. This is one of the reasons why so many people have been losing bidding wars on homes, because you have Wall Street willing to pay top dollar on homes, and they have been buying 1 out of every 5 homes in the country, and in some neighborhoods they're buying 1 out of every 3 homes in the country, and they're willing to pay, in some cases, tens of thousands of dollars over the asking price. Wall Street has already spent over $60 billion buying up homes around the country, which is very interesting because traditionally Wall Street hated the idea of investing in real estate. Your traditional investment portfolio, especially if you have any sort of money manager from a bank on Wall Street or any sort of financial advisor, is going to say that you should invest your money in cash, you should have some money in stocks, you should have some money in bonds, and you should have some money in CDs. They never mention anything about real estate unless you're investing in real estate trusts, which is something that you buy on the stock market. Part of the reason for that is if you're investing in real estate, they're not making any money off of you. So if Wall Street is pouring billions and billions of dollars into the housing market, artificially inflating housing prices, making it harder for people to be able to afford homes, are they creating a housing market bubble? And that concern is pretty legitimate considering Wall Street has been on the forefront of a number of bubbles in the past. So what I want to do today is start by talking about what's going on and what Wall Street is doing, how this affects you, and what might be coming in the future. And before we jump into this, I want to give a quick shout out to Reventure Consulting, who made a video on this topic, which inspired me to make this video. If you want to watch his full video, I'll link it for you in the description. Now let's jump into what's going on with Wall Street and the housing market. Let's start by taking a look at the growth of investors in the housing market. CoreLogic put this together, and you'll see that before the pandemic, investors were buying somewhere between 18 and 15% of homes that were listed for sale. But now, after the pandemic, it has shot up to almost 30% of all homes. That's why in some neighborhoods right now, you're seeing investors from Wall Street buy nearly 1 out of every 3 homes in a neighborhood, which is why it's so difficult for people to be able to buy homes, because you're competing against Wall Street, which has billions of dollars in their pocket, and so they can overbid on homes because, well, they have the money to do so. Now, it's nothing new that investors are buying homes. I mean, you've been seeing small and medium-sized investors buy homes for decades. That's always happened, where you have people that want to buy homes and then they rent it out. But what's new is how aggressively Wall Street is buying homes. Figure 3 shows the different classes of investors and how aggressively they're buying homes, and this bottom line right here are your large investors. That's hedge funds, those are your Wall Street banks, and you can see that after the 2020 pandemic, they have been buying homes like crazy, while your small and medium-sized investors have been slowing down because they just can't afford to buy more homes. So Wall Street isn't just pricing out people that want to go out and buy a home to live in, they're also pricing out your smaller investors. This is something that we've never really seen before, because before, anytime you'd see these big institutions and corporations invest in real estate, they didn't want to deal with single-family homes because that's the big headache. You have to deal with so many different roofs, you have to deal with so many different furnaces, and they're all located in different places in the country. That's why you'd see them invest in commercial real estate. They would buy and create these big apartment complexes. They would buy office real estate. They'd buy different types of massive real estate because it's a lot easier to manage. I mean, if you have 100 units in one apartment complex, it's easier to manage that than 100 homes spread across different cities in the country. Redfin did their own study to see how many single-family homes that investors are buying, and you can just see the number explode after the pandemic, where investors are buying more homes as investments now than ever before. So the first question that you want to ask and understand is, why in the world is Wall Street buying up all of these single-family homes? Well, what you have to understand is Wall Street is in the business of trying to get a return on their money. And traditionally, Wall Street likes putting their money into paper assets, stocks, equities, things where they can easily sell their assets and see what type of returns that they're getting. But the issue is, well, stocks have been very overvalued, and the valuations of some of these companies are extremely high. Like, some companies on Wall Street are selling for 50 to 100 times multiples, which means that for every dollar that they earn, the price of the company goes up by $100. That's where these hedge funds and institutions are always looking for the next best thing. where can we put our money now where nobody else is looking, where we can get a massive return on our money before everybody else goes. Wall Street has always had some sort of exposure to real estate, typically in the form of REITs. A REIT is a real estate investment trust, and these are companies that go out and invest in real estate. So a lot of these REITs are your corporate real estate investors. They own your large apartment complexes, they own your large office buildings, they own some of the large hospital buildings, and so they're the companies that are going out and either building or buying these massive buildings. But there's a couple issues with that right now, because on one hand, the entire office market is completely changing because of this pandemic. I mean, companies just don't need as much office space as before, so we have a massive surplus of office space in the United States, and so you have some banks and institutions on Wall Street that don't really want to touch that anymore because it's not as needed as it was before. Same with retail real estate. This is one of Wall Street's favorite places to invest their money because they would invest their money into shopping plazas and shopping malls, which used to be a very safe place to invest your money, but now because of the digital revolution, people aren't going to shopping malls as much, they're not going to shopping plazas as much, so that's just not a very attractive place to invest your money in real estate. That leaves only one type of real estate to be technology proof: residential real estate, because no matter what happens in technology, we're always going to need a roof over our heads, we're always going to need a place to sleep, and traditionally, these institutions were investing their money into big cities, places like New York and Chicago, places where you would want to live, work, and play at the same place. But because of the pandemic, many people have been moving out of the big cities into suburbs. And it's also harder right now for corporations to be able to build more of these buildings just because we still are dealing with a labor shortage, even though unemployment is still supposedly low, and we still are dealing with supply chain issues, so it's much more expensive and much more difficult to build these type of buildings. So Wall Street is looking at their options. Where can we take this money? The stock market is overvalued. Some of these startups are overvalued. The commercial real estate market is not making any sense. We don't want to invest it into these apartment complexes into big cities because we don't know if people are going to still want to live in these big cities. And that leaves them with single family homes, which is a market that Wall Street traditionally never wanted to touch because it's extremely difficult to manage a whole bunch of single family homes. You're dealing with a bunch of different people, and you're also dealing with a whole bunch of different maintenance requests in different parts of the country. But now when you're comparing all of these options, you have some hedge funds and institutions saying, we'll take that risk. We'll start investing in single family homes. And the great thing is we don't have to compete against a whole bunch of other hedge funds and institutions because we're just competing against your regular mom and pop people who want to buy a home themselves. So when you look at all of these options, hedge funds are now saying, well, the stock market and companies are too overvalued and commercial real estate is too risky, and keeping this money in cash is also risky because we're losing value to inflation. So let's go out and buy a tangible asset where we're not competing against other institutions. Let's go out and buy homes. The reason why this is so interesting to me is because I'm a real estate investor, and I started investing in real estate after the 2008 crash, and that was when banks were just liquidating homes at pennies on the dollar. And I remember thinking to myself, why don't banks just hold on to these homes? Because they're now selling these homes at major losses, and if they were just able to create a system where they could renovate the homes and rent it out, they wouldn't lose as much money. But these banks were not in the business of renting homes. They're not in the business of flipping homes. All they wanted to do was lend money, and they wanted to get rid of the real estate as fast as possible, which is why they were selling real estate in some instances for literally 95% off. They were losing 90 to 95% of every dollar that they invested into these homes because they were just liquidating them. Now, bear in mind that I'm from Michigan, which is one of the hardest hit markets in the country, but that's what I was seeing happen. Now you're seeing hedge funds saying, well, we don't want to miss this opportunity now, so they're buying up homes across the country as a way for them to own some tangible assets and create some rental real estate cash flow. Now, before I go into whether Wall Street is going to create a bubble or a crash in the housing market because of what they're doing, let me talk about what this means for you, because if you own a home, or if you want to buy a home, or even if you want to rent a home, this is going to affect you. So pretty much if you live in the United States, it's going to affect you. Home prices are determined ultimately by supply and demand. When you have a lot of people that want to buy a home and not that many homes available for sale, this pushes home prices up. On the flip side, when you have a lot of people selling their homes and not that many people buying homes, this pushes home prices down. Right now, we are in an environment where you have a lot of people that want to buy homes, a lot of banks and institutions that want to buy homes, and very little people actually selling homes. We have one of the smallest inventory of homes ever, and so you have all these people and now all these banks and institutions coming with all this money wanting to buy homes, which is pushing home prices up. At the same time, we're also entering a market where it is going to become even more expensive to buy a home, even if home prices don't go up, because interest rates are rising. We've already seen interest rates rise quite a bit in 2022, and the Federal Reserve Bank hasn't even started raising interest rates yet. We know that the Fed needs to raise interest rates to fight inflation, and they keep saying that they're going to raise interest rates multiple times in 2022. So once the Fed starts raising interest rates, it's going to become more expensive to buy a home, because now your mortgage is going to become more expensive and refinancing a home is going to become more expensive. Typically what that would mean is you would see some sort of home price correction, because in 2021 we saw home prices grow by something around 19%. So this is home prices, and we saw wages grow only by 4% in 2021. Now, home prices cannot sustainably continue growing this much faster than wages, because people are not going to be able to afford homes. They're going to get priced out of homes. We've already been seeing that happen. We saw it happen in 2021. We're seeing it happen even more in 2022. And so if more and more people can't afford homes, you would think that home prices would have to go down, because now homeowners are going to say, oh, nobody's buying my home because our home is too expensive and mortgage costs are too high, so we're going to have to cut the price of our home. But now you also have to factor in the fact that it's not just home buyers that want to buy homes, and it's not just mom and pop investors that are trying to buy the homes. You have Wall Street, which is backed by billions and billions of dollars, trying to buy up homes. So for them, they don't really care about what's going on with these little mortgage rate increases. They don't really care if home prices continue going up. They will continue fronting the bill. So you have to think that even if it becomes more expensive to own a home, that Wall Street will continue buying, and that their share of home ownership will continue to rise, even if regular people cannot afford to buy a home. That would in turn make renting a home more expensive, because that means your costs are going to go up with home ownership as well. Property taxes would go up. If home prices go up, your property expenses go up. And so in order to mitigate these costs, you're going to have to raise rents. But real estate is very localized, and where these hedge funds are buying homes is also very localized, which is why some areas are going to see bigger rises than others. This chart is going over the top areas that are being bought up by investors, and what you see is that San Diego, San Fran, Nashville, Orlando, Tampa, Las Vegas, Miami, Jacksonville, Charlotte, Phoenix, and Atlanta are some of the areas that have the highest rate of investors buying homes. Like in Atlanta, Phoenix, and Charlotte, you have investors buying almost 1 out of every 3 homes that's sold in these neighborhoods. So if you're in the market to buy a home, it pays to understand what's going on around you, and it looks like home prices are going to continue to rise even if interest rates go up, as long as Wall Street continues to buy homes at this rate. But there is a chance that one day these hedge funds wake up and say, you know, this home buying business is way too time consuming, is way too labor intensive, and it's not for us, so we're going to shut it down. We saw Zillow do the exact same thing. One day they woke up and they shut down their multi-$100 million business just because they were losing money and they couldn't manage it. Now, as a little bit of a heads up, if you are in the market for a home and you want to secure a lower interest rate mortgage or refinance, you want to do that sooner rather than later, because the Fed will probably raise interest rates multiple times in 2022, which will make it more expensive for you to borrow money. So if you are interested in that, just keep that in mind. And as you're shopping around, make sure you do actually shop around, because some lenders are going to charge you a whole lot less in fees and interest on the exact same loan. And it's a whole lot easier to do that now than before, because you can just use a mortgage comparison tool online. This brings us to the third thing that I want to talk about, which is Wall Street creating a bubble by buying all of these homes across the United States? The reason why you invest in real estate is ultimately to make money, right? And the way that you make money in real estate is a little bit different than the way you make money in typical investments. In most of your traditional investments, the way you make money is you buy an investment and then you want to sell it for a profit. In real estate, it's a little bit different. You buy a home like this, and then you're going to rent it out to somebody else, and then they're going to pay you rent for you giving them access to your home. Well, what we've been seeing happen is because home prices have been going up so fast, rent prices have been going up too, but the returns on homes have been dropping significantly. To put it in perspective, when I first started investing in real estate after the 2008 crash, I was able to buy a home very easily for around $30,000 in a gray area. Now, I know this is going to sound crazy. $30,000 for a home, that was the market. After the 2008 crash, especially in Michigan, you were able to go into great areas with great schools and lots of businesses and buy a home for 30 grand. So these $30,000 homes were then rented out for $800 to $850 a month. Nowadays, in today's market, that $30,000 home is selling for something around $150,000 to $200,000. So home prices have gone up significantly, but rent prices have gone up from $800 to $850 to maybe $1,100 to $1,300. So rents have gone up quite a bit, but nowhere near the amount that home prices have gone up. Now, there still are quite a bit of neighborhoods here in Michigan and other parts of the Midwest where you can buy homes with the 1% rule, which means you buy a home and then you rent it out for 1% of your cost to buy the home. So if you buy a home for $150,000, you rent it out for $1,500 a month. You just have to know where to look. But that's not the entire country. If you're from Manhattan or San Francisco or Phoenix and you're watching this, you're gonna say, $150,000 home? What the heck are you talking about? But those do exist in the Midwest. But what we've been seeing happen is that a hedge fund on Wall Street doesn't care about getting the same returns as a smaller investor does, because a smaller investor needs to make a profit because that's the money that they're going to use to pay their bills, it's the money that they can use to pay all their expenses, and that's also going to be the money that they use to pay themselves. Versus an investor from Wall Street, well, they might have thousands of different homes, so they don't necessarily need to make as big of a profit on one home. So what that means is they've been able to then drive up the prices of homes, just that way they can acquire more homes quicker and they're making smaller returns. When I invest in real estate, I'm looking for a 7% cash on cash return, which means for every dollar that I invest, I want to make 7 cents in positive cash flow. Now, when you go into these bigger cities, you go to Phoenix, you go to Texas, you go to California, you go to New York, you're not going to see this type of 7% return. You might be seeing a 3 or 4% return. When I was in Austin, Texas and Phoenix, Arizona in the later part of 2021, I was looking at some investment properties over there and they were being actively listed at a 1% return. Which means if you bought, say, a home for $100,000, they don't have $100,000 homes, but just for the sake of this example, you buy a $100,000 home, the $100,000 home is going to make you a $1,000 profit over the course of a year. Or if you want to use bigger numbers, if you go out and you buy $1 million home, you're going to make $10,000 worth of profit. Now, this 1% return doesn't really leave you with much of a margin, which means if something goes wrong, now you have to pay money out of your pocket. And the reason why these homes are able to sell for a 1% return is because the sellers are saying, well, rent prices are going to continue to grow by 10 to 15% a year. And if rents continue to grow by 10 to 15% a year, you're going to see a growth in your rental income. So you don't need to worry about the fact that you're not going to make any money for the next year or two. But in the future, that's when you'll start to be able to make a profits, and your home value or your real estate value is going to be so much higher that you'll be able to sell it for a profit. So let me diagram what this means. Let's say this home is now $1 million. I'm gonna go up and buy this home for $1 million, and I'm essentially gonna make no money in cash flow. I might even have to pay money every single month in order to maintain the home, but the goal is now that in a few years this home will be worth $2 million. This is the goal with a lot of real estate investors, especially when we're talking about these Wall Street investors, because this is the type of investment that fits their portfolio. They want to buy something and sell it for a big profit. They don't care if they don't make any money along the way because they want to be able to sell it for a big profit. Now, typically, if you see this type of growth, now you can finally sell the property and finally make some money, or you can refinance out and now you have some cash in your pocket, and now you finally have made some money on the home, but you don't actually make any money unless the home value goes up. This is what Wall Street is hoping for. Here's the concern. In order for this to happen, you're going to need people to be buying this home at this price. And if mortgage rates are going up, which we know that's going to be happening in 2022 and 2023, if mortgage rates go up, that means this $1 million home is automatically going to be even more expensive because your mortgage is going to be a lot more money now to buy this $1 million home than it was a year or two ago. But in addition to that, you also need the money to go out and buy a $2 million home. You need to afford the down payment, you need to afford the closing costs, and you have to afford the higher mortgage costs. Typically, in a normal housing market, when interest rates go up, that causes home prices to cool down a little bit because it becomes more expensive for people to buy homes. And if you have less people buying homes, less demand, and the same amount of supply, well, then the supply now has to adjust the prices in order to accommodate the less demand. In other words, the answer is going to depend on how and when Wall Street wants to make money. This leaves us with 3 scenarios as to what can happen. The first scenario is Wall Street doesn't care about cash flow. They continue to buy homes even though home prices go up and even though it becomes more expensive to own a home. So now we see home prices go up, we see the cost to own a home go up because interest rates go up, but Wall Street doesn't care. less and less people are going to be able to buy homes because home affordability will continue to go down, but Wall Street keeps buying because, well, they don't care. They think that they'll be able to sell their homes for a big profit in the future, so they just keep buying and buying and buying, and this will continue to push home prices up, and America essentially becomes a renter nation because now Wall Street and hedge funds own 50% of the real estate in America, and now hedge funds are just buying homes and selling homes to each other, and the homes in America are owned by Wall Street. In that case, home prices will continue to go up, and this bubble will continue to just inflate and inflate and inflate. Scenario number 2 is Wall Street says, you know what? We don't want to wait to see our profits. We don't want to wait to sell our home. We actually want to start generating cash flow. And so now in this scenario, if interest rates start to go up, and less and less people want to buy a home, well, then these institutions on Wall Street might say it's not making sense for us to buy these homes anymore because our monthly payments are so much higher and the rents that we're getting are not supporting these monthly payments, so we're losing water on these homes that we're buying and we can't afford to buy any of these homes anymore. If that happens, then Wall Street might stop buying homes, or they might start selling their homes because their debt payments are so high that they cannot afford their monthly costs. So if this happens, this could push Wall Street to sell their homes, and this would completely flip the market, and now you have a whole bunch more sellers. And the scenario number 3 is you have some sort of X factor, where Wall Street wakes up one day and they say, it is too difficult to manage these homes. We cannot manage all these different roofs. We cannot manage all these tenants. We don't have the infrastructure in place because it is difficult to manage these homes, even if you have a property management company, because they have to have the ability to manage all of these homes. And we haven't seen this big of a growth in real estate investments really ever. So the infrastructure to manage all this real estate is really not built yet. Or maybe we see some sort of government regulation come into play where the government says Wall Street has to go through other hoops, they have to pay other fees and fines if they want to be buying single family homes. I don't know what will happen with that. I mean, after we saw the mortgage moratorium and the eviction moratorium happen after the 2020 pandemic, I always start to include this X factor because we never really know what's going to happen. The housing market has been creating a lot of tension lately. Home affordability has dropped to its lowest levels ever, and that means it's becoming harder and harder for somebody to go out and buy a home, especially first-time home buyers. And for the most part, that translates to no other than the Lululemon wearing, Frappo Macchiato sipping, and the extra guac eating millennials. Millennials have been fortunate enough to live through 2 different housing crises, which translates to millennials having the lowest rate of home ownership ever. Now, of course, part of it has to do with the spending habits of millennials who love spending money on Lululemon and Frappo Macchiatos at Starbucks, and of course, the extra guac at Chipotle. But you can't ignore the fact that housing is becoming extremely expensive, which is making it very difficult for all people, millennials, old people, young people, to go out and buy a home. This dilemma is now pushing more people to rent than buy, which is now pushing rental prices up through the roof too. Rent prices have been skyrocketing across the country, and some areas have even seen rent prices grow by 40% in just the last year. This housing market issue has become so bad that our friendly neighborhood financial savior is now coming to the rescue again. And this time, it's not Jerome Powell and the Fed with their money printer. This time around, our financial savior is the United States government. Home prices have gotten so far out of hand that now the government says that they will be backing mortgages up to $1 million in some areas, and they're also loosening our refinancing restrictions to make it easier for you to borrow money against your home. Home prices have become so expensive because of government programs, because the United States government wanted to create more inflation and they wanted to lower interest rates, making it more easy for people to go out and buy a home. And now that they've done that, home prices have gone up so much, and so their solution is, well, let's make it even easier for people to go out and buy bigger homes and borrow more money, which would ultimately make home prices go up even more. Wait, isn't this just gonna make the home affordability problem worse? Shh, just listen to the sound of the money printer. What's even more interesting is their reasoning, because Fannie Mae and Freddie Mac published a blog post on their website saying that this housing market is the new normal. What makes all of this so concerning is that it's all happening at a time where the Fed wants to start raising interest rates to fight inflation. It's no surprise that we're seeing record high inflation, which is why the Federal Reserve Bank is now saying that they want to start raising interest rates to fight inflation, and we might even see our first rate hike in March. If you want to understand how all these things are going to affect the housing market in the future, future, you have to understand where we came from, at least over the last couple of years. In January of 2020, we were already in a strange housing market because the government wanted to stimulate the economy. In 2019, if you wanted to go out and get a mortgage, it was going to cost you something around 4.5% a year. But then under President Donald Trump, he pressured the Federal Reserve Bank to slash interest rates. And so in January of 2020, if you wanted to go out and get a mortgage, it was only going to cost you something like 3.7% a year if you got a fixed rate 30-year mortgage. Now, the reason why they started to do that was because they wanted to stimulate the economy and they wanted to stimulate the housing market. When interest rates go down, more people are likely to go out and buy a home. And so when this happened in January of 2020, we were already seeing record low inventories of homes. So people were struggling to get a home at this time because people were trying to capitalize on these low interest rates, and there weren't that many homes available for sale. So the supply issue of homes started before the pandemic even started. In January 2020, we had that low inventory issue, and at this time, the median home price was $295,000 in the United States of America. Then came the pandemic, and in April of 2020, that's when we saw listings freeze. People were scared of the pandemic, nobody knew what was going on, and that's when the Federal Reserve Bank started slashing interest rates because they wanted to stimulate the economy. The entire country shut down, so nothing was moving, and so the only way that they could stimulate was by creating more inflation. So in April of 2020, if you wanted to get a mortgage, it would be right around 3.3% a year, assuming you get a 30-year fixed. And the interesting thing here was that nobody was buying home. The average home sat on the market for 62 days because people didn't know what was going on with this pandemic and people were not buying homes. That's when the early movers who wanted to capitalize on the low mortgage rates came out and they started buying homes. By October of 2020, mortgage rates had fallen to 2.8%. and the average days on market for homes fell to 53 days because now people wanted to scoop up the homes, and this is when we really started to see the listing issue where there was a very small supply of homes. So now everybody who wanted to take advantage of these low mortgage rates and home prices that had not skyrocketed did that between April and October of 2020 because you didn't see massive home price growth yet. But the people here were able to capitalize on these super low mortgage rates and were buying homes before they really started to skyrocket. This is when sellers started to catch on. They realized that there's not that many homes available for sale, and you're starting to see more and more buyers enter the market who want to capitalize on these low mortgage rates. So that's when home prices really started to go up. By March of 2021, sorry if you can't read my handwriting, by March of 2021, now the inventory issues really are becoming big issues because the inventory of homes are less than 50% of what they were just 1 year ago, and now you can still get a mortgage for right around 2.8% a year. But the craziest part is that in October of 2021, the median home price in America jumped up from $295,000 in January of 2020 to $370,000 just over a year later. 2021 was the year of the housing market because the market kept booming because everybody started to have FOMO. They didn't want to miss out on this housing market trend, so everybody tried to go out and buy a home. And then by October of 2021, you started to see mortgage rates go up slightly. By October, the average mortgage rate for a 30-year fixed rate was around 3% a year. But also by this time, the days on market fell to about 45 days on market, and the median listing price for a home in America jumped up to $380,000. Then came January of 2022, where now the Federal Reserve Bank really started to issue some warning signals about inflation, and they said that they were going to start raising interest rates because of all this inflation, and that's where we saw mortgage rates start to pick up. Mortgage rates went up to about 3.45% for a 30-year fixed in January 2022, which is still historically very low, and this is before the Fed has really started to ramp up interest rates, so you can expect interest rates to continue to go up in 2022. But even with the higher interest rates, January of 2022 was the hottest January in the housing market in recorded history. So now that you understand where we were, let's talk about where we're going, and we can start by going to smash that thumbs up button below. Fannie Mae has said that they project home prices to go up by 7.6% in 2022. At the same time, it's projected that wages will continue to grow quite a bit in 2022, but it's not going to keep up with home prices. We've never really seen that happen, but it's projected that wages will grow by 3.4% in 2022. What this means is that home prices will become even less affordable in 2022 because on one hand, you have home prices that are growing significantly faster than wages, but then on top of that, homes are naturally going to become even more expensive because interest rates are going to go up. The Federal Reserve Bank has said that they want to increase interest rates multiple times in 2022, which means your mortgage is going to become more expensive if you go out to get a mortgage in later 2022 or in 2023. So it looks like the home affordability crisis might be getting worse. Generally speaking, it's hard to have a housing market that's growing in price significantly faster than wages because that means over time you're going to have less and less people that are going to be able to afford a home. So you want to see wages keeping up with home prices, but the reason why that's not been happening is because you've had low supply of homes with a very high demand of homes coupled with super low mortgage rates. On the supply side of things, it's no surprise that we have a limited amount of homes available for sale. It's not just the fact that people aren't selling homes fast enough, we don't have enough homes in the country to meet our growing demand. Core logic says that we will need about another 5 million homes to meet the amount of demand that we have for homes, and we just can't build homes fast enough. I mean, not only are we having trouble sourcing the materials, the lumber, and all the other parts, but we also have a labor shortage. Remember the Great Resignation? And so you have a lot of construction companies that are struggling to find labor to build homes, and if they are able to find labor, the labor today is costing them a lot more today than what it did a few years ago, and so all these things are pushing the price of homes up because you just can't build homes fast enough or as inexpensive enough. Just a few years ago, you used to be able to build a nice starter home for about $250,000 in a big chunk of the United States, but today, to build that exact same starter home, it's going to cost you 1.5 times that because of the higher cost of materials and the higher cost of labor. So just like everything else, one of the biggest issues in the housing market right now is that we have a very small supply of homes available for sale, and we're starting to see the supply inch up, but it's still nowhere near where we need it to be to help meet all the demand. On the flip side, the demand side of things, we've seen the complete opposite. We have a booming demand for homes because of a couple reasons. One is because of low interest rates, but the unexpected reason is the change in our economic environment. When we entered the pandemic and the initial recession, the Fed started cutting interest rates to stimulate the economy because when interest rates are low, more people are more likely to go out and buy a home, and when people are buying homes, well then real estate agents are getting paid, title companies are getting paid, mortgage bankers are getting paid, the bank companies are getting paid, contractors are getting paid, so it helps grow the economy when people are buying homes. But the unexpected thing that happened was the shift in our economy, because what happened was we saw the shift to the work from home movement where people realized, oh, I don't have to go into the office to go and work, and so people wanted to now move out of the cities into suburbs, and they wanted a home where they can upgrade, where they can have their own office, and where they can spend more time. So now people naturally wanted to buy a home because they wanted to upgrade and have a home that they could work out of. When you couple that economic shift with the lowest mortgage rates in the history of time, well, you create one of the biggest demand booms in the housing market that we have ever seen in our history. If we zoom out and think about this on a smaller scale, think about it this way. If you have 5 sellers of homes and you have 5 people that want to buy homes, it's an equal supply and demand, and so it's not like one party has a bigger upper hand over the other party, because if you look at one home and you don't like it, well, you can look at the other home or the third home. But now if we have 5 homes available for sale and you have 100 people that want to buy these 5 homes, now you don't have that same type of leverage, because if you don't like this home, well, you might lose it to somebody else, and if you don't like this home, well, you might not even get it because you have 20 other people that are trying to buy this home. And so when you have a lot more demand than supply, well, now you want to buy this home and you know that you're competing against 20 other people, and so now if you want to get this home, you have to be willing to pay more money. You are competing against all the buyers, and that's what we've been seeing happen, and that's what we're going to continue to see happen until we see more supply or until this demand starts to go away. Now, one of the reasons we can see this demand slow down is if homes become even more expensive. Now, that can happen through higher home prices, but that can also happen through mortgage rates going up, and we know that mortgage rates are expected to go up in 2022. What that means on your end is if you want to lock in a low mortgage rate or a refinance rate, it's better to do that sooner rather than later because we're already starting to see mortgage and refinance rates start to creep upwards. And when the Fed starts to raise interest rates, you can bet that mortgage and refinance rates are going to go up even more. So if you want to lock in these rates, you don't want to keep waiting because if you do, then you're going to be the one paying the higher prices for your mortgage or refinance. And as a little tip, make sure you shop around because some lenders are going to charge you a whole lot more in interest and a whole lot more in fees on the exact same loan. So if you're going to be borrowing $500,000, you might as well borrow it from the lender that's charging you the least amount of money. And luckily, thanks to the internet, you can just use a mortgage comparison tool, which will help you do that so you don't have to hound each one of the lenders and try to call around and try to figure out each individual lender's rate. What we've seen happen time and time again in history is every time the government sees a problem and they try to fix it, they end up making the problem worse. And the concern is that we might see that the exact same thing happen now in the housing market. In this case, to help combat rising home prices, what the government wants to do is they say that they will be willing to back loans up to $1 million or almost $1 million in certain areas around the country. Fannie Mae and Freddie Mac are government-sponsored entities who have one goal. They want to help more Americans become homeowners. They're not issuing loans directly to people. So you can't go out and borrow money from Fannie Mae and Freddie Mac. Instead, what you do is you go and borrow money from a lender or a bank, and then Fannie Mae and Freddie Mac tell the bank or the lender, hey, don't worry, we will insure the loan that you just gave out. When a bank lends out money to you, they're making an investment. And so when they make this investment decision, they want to make sure that they get their money back. That's why they look at things like your credit score and your income and how long you've been getting paid. And so if you go to the bank and you don't have the best credit score or you don't have a great work history, then the bank is probably going to say, no, we don't trust you with our money because if you don't pay the bank back, well then the bank's money is at risk and nobody likes losing their own money. So let's assume that this is you. I'm going to draw a nice mustache for our male followers and I'm going to draw a nice braid for our female followers, or as we like to call it in my native language Punjabi, a gut. Now, you go to the bank and you want to get a mortgage. The only problem is you don't have a lot of money for a down payment and you don't have the best credit score. Typically, the bank's going to look at you and say, no, we don't trust you with our money. You are a risky investment because the bank doesn't want to lose their own money. But the problem that the government had with that is that if the bank is rejecting a whole bunch of people on their home loans, well, then people won't be able to buy homes and that's going to hurt the economy and that doesn't look like a good thing to the government. So what we have here are your government agencies. In this case, it is Fannie Mae and Freddie Mac. Now, Fannie Mae and Freddie Mac were private entities, but then after the 2008 real estate collapse, they became absorbed by the government and now they are government-sponsored entities, which means they're kind of private, kind of governmentized, and so it's somewhere in the middle. And so what happens here is Fannie Mae and Freddie Mac will then buy the loans from the bank to insure the bank against these loans to people who are getting things like an FHA mortgage. So again, an FHA mortgage is where now you have to buy a home and you don't have the best down payment. Maybe now you're only putting 3.5% down and maybe you don't have the best credit score. You can qualify for an FHA mortgage. The bank will give you money and then the bank is going to sell your loan to the government agency, in this case Fannie Mae and Freddie Mac, which insures the bank. So now the bank doesn't have to worry if your credit score isn't the best. The bank doesn't have to worry if you don't have the best down payment because it's not the bank's problem. So now Fannie Mae and Freddie Mac are buying these loans and they also get some insurance to help protect them, but Fannie Mae and Freddie Mac are also backed by the full faith and credit of the, put it this way, United States government. Now that sounds really nice in theory because now your bank is supported by the Fannie Mae and Freddie Mac and Fannie Mae and Freddie Mac are backed by the United States government. The only problem is the United States government doesn't have any money. The United States government is drowning in debt. They barely have enough money to pay their bills as it is. So if the United States government is backing Fannie Mae and Freddie Mac, how are they supposed to do anything if Fannie Mae and Freddie Mac run into issues where people start defaulting on their mortgages? Well, that brings up the next question. Who is backing the United States government? Well, to answer that question, you have to understand who is funding the United States government. The person who's funding the United States government is none other than you, taxpayers. Taxpayers are the people that are backing the United States government because if it wasn't for your tax dollars, the United States government wouldn't have any money to do well, anything. The reason why this is so important to understand, because now we are seeing home prices go up so fast, and part of the reason why we're seeing home prices go up so fast is because we're seeing unprecedented demand. And one of the reasons why we're seeing such high demand for homes is because a lot of people can buy homes even if they don't have a very high down payment and even if they don't have the best credit score. And now, to help more and more people buy a home in this home affordability crisis, what the government wants to do is they want to increase the size of loan that you get from here, because previously the loan sizes were smaller, and now in some areas they're saying that they will be willing to back loans up to nearly $1 million, which means now we'll have more people be able to go out and buy a home, which means that there'll be a bigger demand, which ultimately means that that would help push home prices higher, or at least keep them high. Now, if you're wondering whether this is a good thing or a bad thing, it really just depends on who you are and where you are in this situation. Because if you want to go out and buy a home, well, then this is a good thing, because now you can go out and get an FHA loan at a higher price. But if you don't plan on buying a home for a little while, well, then this is bad news, because this will help push home prices even higher. And if you own a home right now, then this is good news, because that means home prices will continue to go up, because now you'll have more buyers coming in. So it's good news for some, bad news for others, and it's okay news for people in the middle. It just depends on who you are and where you are in the situation, which is why the saying one person's trash is another person's treasure is so true, especially when it comes to money. We're seeing similar changes go into effect on the refinancing side of things too, because the government has said that they're willing to loosen the restrictions for some of the refinancing, and they're willing to increase the amount of money that you can pull out, again, to help stimulate this business. The concern that everybody has in the back of their mind is, do these programs create a bigger housing bubble? Because remember, before the 2008 crash, one of the biggest factors leading up to that collapse was a lot of people started to buy homes who shouldn't have bought a home. And so if we are loosening restrictions, we're increasing the amount of money that we're lending out, could this create a similar type of bubble? The thing that I always find funny goes back to what I said just a minute ago, because oftentimes the things that the government tries to do to help people oftentimes end up hurting those same people. If you go back to the CNBC article talking about the mortgage refinance programs, the first bullet point says that the goal of Fannie Mae and Freddie Mac's refi program is to help low and moderate income homeowners take advantage of historically low mortgage rates. In other words, they want to help not rich people go deeper into debt. Now, what are people going to do with their debt? If you use this debt to go out and buy a rental property, or go out and invest in a business and do something to create more wealth, then that's a good thing. But if people are refinancing cash out of their homes and they're not doing that, and they're taking this money and they're going on a vacation, and they're taking this money to go out and buy some new clothes, and they're taking this money to go out and buy a new car, is that really helping the low and middle class people? Again, it depends on what side you're on. On one side, you can say, yes, it's helping them. It's helping people buy the things that they want, and it's going to help stimulate the economy, which means it makes wealthy people wealthier, because now if you own shares of the companies that these people are buying products of, well, you're becoming wealthier, because now people can buy more things. But on the flip side, if we just look at the financial education side of things, especially because I am a money nerd and I like spreading this financial education, then it doesn't look so good. Because now you are going deeper into debt, and you have no financial education, and now you borrow more money at record high prices, and now you are using this money to make yourself broker, and now you are left with just a mountain of debt. The one point that I want to hammer home here is that none of this is a problem until it becomes a problem. Like, credit card debt doesn't become a problem until it is a problem. And too much mortgage debt and being over leveraged isn't a problem until it becomes a problem. If home prices fall and people start to become overwatered because they over refinanced or they bought a home that they couldn't afford, well, that's when it becomes a problem. But when home prices are going up and everybody has equity in their homes and everybody has a job, it's not a problem. It's helping to grow the economy, and everybody who's taking part in it is a financial genius. But what you have to remember is good times don't last, and either do bad times. Everything goes in cycles. You have booms and you have busts, and you want to be prepared for anything, which is why it pays to be financially educated, which is why you want to be aware of what's going on. Buying a home over the last year hasn't been very easy. I purchased a couple investment properties in 2021, and it took more work than before, because now I had to go through more listings, I had to walk through more properties, I had to make more offers, I had to go through more bidding wars. But the market is starting to shift a little bit. And now, if you are in the market for a home or if you own a home, you need to understand what's going on. That way you can stay ahead of the curve and actually get the home that you want to buy. I've been involved in real estate from a lot of different angles. I'm a licensed real estate salesperson, I'm a real estate investor, and I'm an attorney. But in this video, I'm going to be going over some of the things that you need to know if you're thinking about buying a home this year. If you want to have a chance to get your offer accepted on a home, the very first thing you got to do is you have to be pre-qualified. Although the housing market has been cooling, this is still a very hot housing market. It is still a seller's market, which means you still have way more people that are interested in buying a home than there are homes available for sale. So that means you're still probably going to see bidding wars. You're still seeing a very hot seller's market where homes are getting sold very quickly. It's not as fast or as hot as it was, but it's still extremely hot if you look at the grand scheme of things. So if you want to have a chance to get your offer approved by a seller, you have to be pre-qualified. When you're pre-qualified, that tells the seller, hey, yeah, I know I don't have $500,000 in my bank account to buy this property, but the bank has already told me that they're willing to lend me $500,000. That way I will have the cash to buy a property. If you're not pre-qualified, then the seller has to now wait and hope that you can get the cash from the bank to buy the property. In this market, no seller is going to want to do that. If I got 3 offers on a property, one person offered me all cash. They have this cash in the bank and they offered me $480,000, and somebody else was pre-qualified and they offered me $500,000. And then you had person number 3 who didn't have the cash in the bank and they were not pre-qualified and they offered me $520,000. The person's offer, who I would definitely not take, is this person because they're not pre-qualified. I don't want to sit here and lose these potential offers just to hopefully get this extra $20,000 when I know that I can get this money here. Now, between the cash and the pre-qualification, the person I'm going to take is going to depend on how fast I need to sell. If I need to sell tomorrow, then I'm going to take the cash offer. But if I can be patient, then hey, I'll wait a little bit longer and I'll take that extra cash. So before you go out and start looking for homes, you need to get pre-qualified unless you have all the cash in your bank to buy the property without debt. If you want to get pre-qualified in this market, you have to be able to produce 3 things. You have to show your income and prove it, you have to show your assets, and you have to show your credit. When we talk about income, the first thing you got to show is you have to show that you actually have a job. That might be showing pay stubs or other proof of employment, because they need to know that you're making money today and that you keep making money tomorrow. Then they're going to want to see at least a couple years of tax returns. This would be your W-2. So they're going to want to see pay stubs and W-2s, because your W-2 is going to show them that you have been making money consistently, because when the bank lends you money, they're essentially making an investment in you and they want to see that you have been making money. That way they know that you'll continue making money, so that way the bank knows that they'll keep making money. Then they're going to ask to see what assets you own and how much debt you have. So they might ask about your car, your student loans, and if you have any real estate investment properties, they'll take a look at that. If you have money in the stock market, they'll take a look at that. That way they can see, okay, this person is a good investment. Yeah, they're making good money and they own assets, they own stocks, they own other investments. That way we know that we're protected as the bank. And the third thing the bank is going to look at is your credit score. Right now, if you want to go and get a mortgage, you really need a credit score of something around 620 minimum. But if you want to get the best interest rates come somewhere in the 740 to 760 plus range. Anything above 760 is going to be all the same. It doesn't matter if you have an 800 or 810, you're going to get the same interest rates as somebody does here. But if you want to get the best interest rates, you need to be in this range. You can still qualify for a mortgage. Here, you can even get a mortgage if you have a 580, but then you're going to have to pay extra fees and extra interest. But if you want to get the lowest interest rate possible and you want to save the most money on your mortgage, you need a better credit score, because this tells the bank that you're more likely to pay your mortgage back on time. Once you have your pre-qualification letter, you know how big of a home that you can afford, and when you make an offer, now you can feel confident that you'll be able to produce the cash when it comes time to close on the property. The second thing that you have to do is you need to know how to compete in this seller's market that we're in right now, because we're in a very unique market where sellers have the upper hand. This is just the reality. So now what you need to do is understand how you could get on the seller's good side. That way you can get your offer accepted. The first thing you have to do is you have to be quick. When you see a home that you like hit the market, you need to go see it that day or the next day. You do not have time to waste in this market, because if you wait 10 days to go and see the property, chances are if it's a good home, it's going to already be sold. So you need to go see this property quick before everybody else does. That way you can make an offer quickly. Then when you make your offer, you want to make sure you make your offer offer attractive. If you cannot offer more money, that might mean closing quickly or being more flexible in the closing time. That way, if the sellers want to stay in their property longer, you're flexible with them. Or if the sellers want to move quickly, you can work with them. You want to make sure that you express that you are willing to work with the seller with whatever they need. This is also going to affect what type of concessions you should be asking from the seller, because 10 years ago, we were in a buyer's market where you had a lot of people selling their homes and not that many people buying their homes. So now if you wanted to buy a home, you could ask the sellers to do whatever they want. You could tell the seller, hey, yes, I'll buy your home, but you need to put a new roof on their home, and sellers would agree because they had no other option. If they wanted to sell their home, they had to make concessions for you. Now it's flipped. So if you see a property that has a broken window or if it has some damage on the walls, tell the seller that you'll take the property as is and they don't need to make any repairs. That way you're making your offer more attractive. If there's a lot of work that needs to be done, you can price that into your offer, but you just want to make sure that you're giving your seller something easy. That way they understand that they can just walk away and they don't got to worry about doing any of the work because you're going to handle that. You want to make sure your offer is attractive, because if somebody else comes in and they say, yeah, I'll buy the home, but I need you to replace this window, and you come in and you say, yeah, I'll take a little bit less, but I'll replace the window myself, the seller's going to sell it to you instead of them. And the third thing that you can try to do to make your offer more attractive is to give the seller a little bit of a love letter. Now, this concept might sound really crazy, but I have seen this work in the past, where when you make an offer, you write a letter to the seller saying why you want to own this home. You say that, hey, I love this property, it's right next to my sick parents, I want to be able to live there and take care of my family, and you just talk about why you deserve to own this home. Sometimes, not every time, but sometimes the sellers are going to read that and they will sell you their property even if you do not have the highest offer, just because of that emotional letter you gave them. So the interesting thing about these love letters is that realtors who are listing the property don't like them, because that might entice their seller to sell the property for a lower price than what they could have gotten without the love letter, which means the realtor is going to make a smaller commission. And so sometimes you'll see listings or even states ban these love letters. Like Oregon just announced that they're no longer allowing these types of love letters, but if you are allowed to do it and you really want a property, it doesn't hurt. And the third thing that you can do to make your offer more attractive is to offer a price contingency. Essentially what this is saying is you can make a $500,000 offer on a property, but then if they get multiple offers, you will say that you're willing to raise the price of your offer up to $550,000 and you're willing to beat any other offer by $5,000. So now what this is saying is, let's say you have multiple offers and somebody else offers them $525,000. That means that you'd be willing to offer the seller $530,000 because you wrote in your offer that you're willing to beat any other offer by $5,000 and you're willing to go up to $550,000. So if you really want a home, you can add in this type of price contingency with that ceiling on it. That way you let the sellers know that you're serious and that you're willing to beat any other offer. The third thing you need to remember when you're going out to buy a home in this market is that you do not want to overpay, because your home is a big commitment. And the last thing that you want to do is you find a home and you fall in love and now you overpay for the home and now you're stretching yourself thin to the point where now you have to live paycheck to paycheck just so you could buy this dream home that you didn't want to lose. The first thing you got to do is you got to set a cap on how much you're willing to pay. You have to tell yourself that this is the most that you're willing to pay for a home, and that's it. If you lose out on a couple bidding wars, so be it. More properties will come. But you also want to make sure that you're not overpaying on fees, because a home purchase is the biggest purchase that most Americans will ever make. And so it's very easy to get ripped off, because just a 1% difference or a 1% fee can add up to thousands of extra dollars that you don't need to pay. So this is where you got to be a little bit careful. Like if we're talking about your mortgage, some lenders are going to charge you a whole lot more in fees for the exact same loan. So shop around. It's the same with your home insurance policy. If you have a home or if you're buying a new home, you want to make sure that you're shopping around for a home insurance policy, because some home insurance policies are going to charge you a whole lot more than other home insurance policies for the exact same insurance. The fourth thing you got to understand is where we are in the market, because there's a subset of people out there that are saying, yeah, I do want to buy a home, but I don't want to buy it yet. I'm going to wait for the real estate market to crash, and when the market crashes, that's when I'm going to come in and I'm going to buy my home for super cheap. The only problem with that is nobody knows when the real estate market is going to crash, and nobody knows how big it's going to be. Right now, at the time of recording this video, the real estate market is very hot. It's not as hot as it was, but it's still very hot. What that means is home prices are still growing very quickly. So home prices keep going up, and nobody knows when the housing market is going to plateau. Nobody knows when the housing market will correct, and nobody knows how big this correction is going to be. Plus, when you're talking about a real estate crash, you really got to understand or pay attention to what factors could potentially cause a real estate crash. Because back during the 2008 crash, the factors that led to that housing market crash were: one, you had a whole bunch of subprime mortgages; second, you had a bunch of ninja loans, which stood for no income, no job, no asset loans, so banks were not qualifying people before they bought a home; and third, you had these variable interest rate mortgages, which meant that you would go out and buy a home, and when you bought the home, your banker would tell you that, hey, your monthly payment's only going to be $500 for the first couple of years, and then it's going to go up a little bit. But what they wouldn't tell you is how much it would go up by. So what happened for so many people is you bought this huge home and you were only paying $500 a month for a couple of years. Then a couple years go by and your payment went up from $500 a month to $1,800 a month, and now all of a sudden you don't have an extra $1,300 a month to put towards your mortgage. And this put so many people underwater on their homes, because now people started selling their homes, they couldn't afford their payments, and now everybody was trying to sell their homes and they didn't have any equity in their homes, and this brought the housing market down, so people went underwater. We don't have those same factors right now. Banks are qualifying people. If you want to go out and get a mortgage, you got to get pre-qualified doing all the things that I talked about. So banks are pre-qualifying people. You're not seeing the same number of variable interest rate mortgages because most people are buying a home with a 30-year fixed rate mortgage. So if interest rates go up or if something changes in the economy, your mortgage payment will not change. The concerns that we're seeing now are a little bit different than before, because now the concerns are home prices are growing way faster than wages, and it's not sustainable for home prices to grow this fast while wages are only growing this fast, because there's going to be a point where now people cannot support this higher price of homes because, well, they're not making enough money to buy these homes. This is where our super low mortgage rates are very helpful, because the lower mortgage rates have been making up for the higher prices of homes. And so when mortgage prices start to go up, that could make buying a home a little bit less affordable, which would make it harder for people to go out and buy a home. But we don't know how fast mortgage rates are going to go up. The Federal Reserve Bank keeps saying that they don't want to touch mortgage rates until at least 2022 and probably until 2023. And even when that happens, we don't know how fast they're going to raise interest rates. And if something happens between now and then, if the economy slows down, if people are not going back to work, then there's a chance that they could even delay this mortgage rate hike if they don't feel the economy is growing fast enough. But even if we put that aside, you also have to factor in the time it would take for real estate prices to come down, because the real estate market, the housing market, doesn't work like the stock market. In the stock market, you can see the market crash in an instant because people have the ability to buy and sell stocks in a second. In the housing market, it doesn't work like that. Buying a home is typically a very slow process. They can take anywhere from a month to a year to sell a home. So if you talk about home prices coming down, it would be a gradual process, because then somebody would have to list their home for sale, and if they don't see any offers, then 3 weeks after listing it, they might cut the price of their home by a little bit, and if they don't see any more offers, then it would take another month before they cut their prices again. So it's a very gradual process. Just like how it's impossible for somebody to time the stock market, it's impossible for somebody to time the housing market. Every asset class, the stock market, the real estate market, is cyclical. There are times when the market is going up and there's times where the market's going down, but it is impossible to time the market. So instead of just trying to time the market, what's better for you is just to buy a home that you can afford. That means knowing how big of a home that you can afford, knowing the down payment, and knowing your monthly payment. If you know these three things, find a home that you love that fits your pricing criteria and go out and buy it. See, I don't consider the home that you live in as an investment. Real estate can be an investment. If you go out and you buy an investment property, a rental property, that's an investment because you're buying it for the sole purpose of making money and you're trying to generate some cash flow from that. But the home that you live in, this is something that you're using. It's a liability. It's something that you're just hoping will go up in value in the future, but you're buying it to live in. And so you really need to treat it like that. If you're buying this property as a place for you to live, as a place for your family to create memories, then you got to look at financially the same way. Instead of trying to time the market, if you want to buy a home that you love, that you can afford. Otherwise, you're going to have to keep waiting until who knows when. Not only can we not predict the economy, but we can't predict what the government's going to do, because the housing market has also been partially skewed because of all the government regulations. Things like mortgage forbearance and the eviction program. These things have changed the housing market. And so you got to remember, there's a lot of external factors that you cannot predict and that you can't control. I mean, nobody thought that we were going to have a pandemic in 2020 a few years before that. And the fifth thing that you need to understand if you're going out to buy a home right now is if you're making sacrifices to make your offer more attractive, you want to make sure your sacrifices are reasonable and that they're not going to turn around and bite you in the you know what. One of the trends that I've been seeing happen right now that really makes me want to pull my hair out is when people make an offer to buy a home and they do not have any sort of due diligence contingency. A due diligence contingency is essentially where you tell the seller, hey, Yes, I made this offer to buy the home, but after you accept my offer, I want somewhere between 3 days and 10 days to inspect the property. I want to bring in my own building inspector and whatever other inspectors I want, and I want us to walk through the property and see what issues are in the property that we might not see. I have purchased a lot of properties, from single family homes to multifamily to mixed use, and one thing that I will not do ever again is buy a property without a due diligence contingency, because out of all the real estate deals that I have done, there was only one deal, one property. It was a single family home that I purchased without a due diligence contingency, and that single mistake cost me tens of thousands of dollars, and that was the only property that I ever lost money on. This is when I was just getting started as a real estate investor, and I walked through this property and it looked pretty decent to me. It didn't look like anything was wrong, so I made an offer and it got accepted, and as soon as I got the offer accepted, everything went wrong on the property. We had to replace the entire sewage line and the plumbing line because apparently somebody who lived in the property prior to me buying it had took cement and they poured it down the main lines of the drain, so water was not leaving the property. We had to redo the entire mechanical and the electrical of the property, and the roof was not in good shape, so then we had to come in and put in a brand new roof on the property. All these things cost tens of thousands of dollars that I did not expect, and this was just a major nightmare that could have been avoided if I just spent a few $100s early on to get a property inspection before I bought the property. So what's happened now in today's market is people want to make their offer better than somebody else's, and so what they've been doing is first they lower the time of the contingency. Instead of saying I want 10 days to review the property, they said I want 7 days, then 5 days, then 3 days, and now people are saying that they're willing to purchase the property without any sort of inspection contingency. When you buy a property without any sort of inspection, you are taking a huge gamble. Don't take that risk. Even if it's a small inspection contingency, even if it's just 3 days, as soon as you get the offer expected, take a property inspector there the next day and inspect the property. It can save you a fortune. Take it from me, just because a property looks good when you're walking through it does not mean that everything is working good. You have to look behind the scenes. You have to look a little bit deeper, and if you are not a home professional, if you are not a contractor, you need to use a building inspector to help you with that. So do not sacrifice that. Make reasonable sacrifices. The more prepared you are, the better. If you have a good real estate agent on your side, they'll be able to help connect you with whoever you need. They can connect you with a lender if you need one. They can connect you with a title company, and they can connect you with a building inspector. That way you don't have to be the person going out trying to find somebody. If you have a good real estate agent, they'll be able to help facilitate this entire process. If you're not making enough money, why is it? Can you work a second job? Can you do something else? Can you learn a new skill? Can you make more money? Sure, that might play a factor, but on the second side of the coin is how are you spending your money? If you're living paycheck to paycheck and you drive a brand new car and you have AirPods and you have a brand new iPhone, then chances are there's more to this problem than just how much money you're making.